All right, welcome to Tuesday, everyone. With today being Sherlock Holmes Day, we're going to continue sleuthing for answers in another installment of our series on blockchain and demand-side energy management. And here to join us once again is Sam Hartnett. Now, if you weren't with us last time, let me introduce you to Sam. He's an associate at the Rocky Mountain Institute, where he currently works on accelerating the adoption of blockchain technology in the energy sector with the Energy Web Foundation. His previous work at RMI includes optimizing microgrid designs and demand management strategies for mines, as well as researching the impacts of time-based tariffs and residential demand response for the largest utility in the U.S. Prior to RMI, Sam spent 4.5 years working at Enernoc, an energy software and demand response provider, where he held various operations and product development roles in Boston, San Francisco, and even in Melbourne, Australia. His experiences included managing operations strategy for demand-side management programs across the Asia-Pacific region, developing tools and applications to automate business processes and decrease operational risk, and creating go-to market strategies for energy management products. In addition to clean energy, Sam is passionate about outdoor education, and he previously worked as a naturalist in Grand Teton National Park, as well as the White River National Forest. Now, before we dig into all things blockchain, I've got to tell you about PowerShift by NV Energy. You can never save too much energy or money. That's why NV Energy has introduced PowerShift to help its residential and business customers conserve even more energy and save money on their power bills. PowerShift by NV Energy is all about providing you with excellent customer service. It's your one-stop shop to find all the energy-efficient products and services to help you boost your bottom line, along with convenient ways to manage your account. PowerShift Energy Advisors are dedicated to working side by side with business customers to discuss their needs and to find energy efficiency solutions that save money. Plus, their Business Solutions Center is the place to go to discuss your bill payments and account-related questions. For more information, please visit nvenergy.com/PowerShift. Now, during the course of today's presentation, you can submit questions for our guest. Simply use the questions box that's probably located on the right side of your screen. I'll review those questions and pose them to Sam during the Q&A time set aside after his presentation. Sam, have at it.
Great. Thank you, Mike, for the introduction, and hello, everyone. So today, I'm going to talk to you all a little bit about blockchain for energy markets. And we'll start with just a brief overview of blockchain technology itself, just to level set the discussion. Then we'll get into the role of blockchain in the context of the broader energy transition. Following that, I'll like to go into more detail about the Energy Web Foundation's reason for being and why we believe that we need a new blockchain infrastructure for the energy sector. And then finally, I'll go through some current market trends, some use cases for blockchain, and a vision for how consumers and building owners may benefit from this technology before we open it up for questions at the end. So blockchain 101. What is it, and what can we do that we couldn't do before? And this will be a jargon-free zone today, and I'm happy to get into the weeds during the discussion about how this all works. But for now, I just want to focus on what blockchain is. So I find it helpful to think about blockchain in the context of the wider history of computers. I mean, blockchain isn't magic, it's just a new way of computing. So to go back, first we had hardware, and hardware lets you store some information and perform some basic functions. And then software came along. So now we're able to leverage these machines to perform more sophisticated tasks. Then we had networks, and this was a new way of connecting machines across many locations such that they had a common set of information. And in each of these developments, things started in really highly specialized products and highly specialized companies that eventually consolidated around a number of key players before eventually becoming commoditized. And so now we have blockchain, and this is a technology that is commoditizing networks. And what does a network do? It enables many machines, and thus people, to access identical information across time and place. It effectively creates a shared understanding of the truth, with an important caveat that the truth is only as truthful as the information that you feed it. So when I say the truth, I really mean verified or validated information. But networks have historically been walled gardens that are operated by single entities with administrative powers to amend, delete, or otherwise change the state of the network. So you have to implicitly trust that that authority is well behaved, but they aren't always. So blockchains are decentralized networks. They use mathematical puzzles and clever incentives and rules to verify that the information on the network is accurate and valid, rather than relying on a central authority. But not all blockchains are created equal. So one of my favorite explanations comes from Vitalik Buterin, who's one of the founders of the Ethereum blockchain protocol, and he provides a really useful metaphor. So the first blockchains were like a hammer, built for one specific purpose. And the most famous example is Bitcoin, which is only capable of transacting digital Bitcoin assets between parties on that ledger. Over time, people innovated and created new types of protocols that could do more sophisticated tasks. So the second generation of blockchain is like a Swiss Army knife. It's useful for several things, but every time you want to add a new feature, you have to redesign the entire product. So it's not necessarily the most scalable thing. Modern blockchains are like a smartphone. So we now have a computing platform that can support any kind of application that you can dream up. And this type of protocol came onto the scene relatively recently, kind of in the early 2010s, and has really matured in the last few years. And so this innovation, this is really why there is now so much excitement in the blockchain space. So beyond thinking of it strictly as a network, we can almost think of it as a decentralized computer that anybody can use. So the computer stores data securely. So once it's entered into the computer, it can never be edited or deleted. The computer can run programs that perform all kinds of functions and automate processes. It lets anybody create a user profile or a digital identity, or they can create programs, which are better known as smart contracts. And users can interact directly with each other, or they can interact with programs, and programs can do the same thing. What I just described sounds pretty much like a normal computer, and to a certain extent, that's true. But actually, centralized computing systems perform much better than blockchains in terms of speed and scale. So why should we care about blockchain in general? Well, blockchain introduces new value propositions for computing. This allows us to create digital assets that can represent either actual physical assets or that can perform some kind of utility function and allow us to transfer value seamlessly. By running programs on this blockchain platform, we have a way to fuse operational systems and financial systems in an elegant way. We no longer need to rely on third parties to serve as authorities. Many parties can now agree on a set of information, even if they don't know or trust each other, and programs can execute transactions between parties in a deterministic way, meaning there is an objective set of information on that platform, and the transactions only happen if certain criteria are met. Blockchains are typically open source, meaning that there's a global community of developers and users, and blockchain can serve as a standard platform for interacting with other systems. It also introduces new forms of cryptography that links every new data entry with all of the ones preceding it. And there's no administrator that is able to delete or retroactively edit data. So we end up with a highly secure, tamper-proof history of all of the actions and transactions that have ever happened. So combining that element with decentralized consensus, this unlocks some interesting opportunities to improve transparency and auditability for all kinds of assets. With that as background, I'd like to now take a few minutes to explain why we think blockchain is a relevant technology for the energy sector. And there are three megatrends that are capturing headlines, spurring regulatory debates, and keeping utility executives awake at night. And these are decarbonization, decentralization, and digitalization. With respect to decarbonization, the trend is clear. Renewables are growing and they show no signs of stopping. And this is driven by a combination of policy mandates, cost competitiveness, as well as consumer preferences. The rise of near zero marginal cost renewables has profound implications on market dynamics and utility business models. But potentially more significant is this trend towards decentralization. And economies of scale have really migrated from upstream to downstream, with distributed energy resources and renewables progressively replacing conventional generation. The cost of electricity supplied from the grid is generally increasing even as demand is flat or decreasing in most industrialized nations. With that, the peak to average demand ratio is increasing, meaning that the utilization of infrastructure is down and fixed costs really dominate the system, and we're trending towards diseconomies of scale. Conversely, the cost of distributed resources ranging from storage to renewable generation to smart devices is plummeting. And we now have IT solutions that are able to coordinate these devices more effectively. And with respect to distributed resources, we're now benefiting from economies of scope. And we're seeing this in markets everywhere. Customers actively choosing devices that enable them to participate in energy markets in new ways and in ways that were unimaginable a generation ago. And underpinning both of these trends are rapid advances in information and communication technologies, which combined are enabling wholly new ways to both monitor and manage the grid. So in contrast to the 20th century, where electricity was delivered one way from massive plants over vast distances to customers at the grid edge, we're now seeing increasingly local production, rapid growth in the number of controllable devices. I think it's interesting, McKinsey estimates that over 120 new devices are connecting to the internet every second. And there are new types of transactions between peers on the distribution network. Combined, these three trends drastically increase the complexity of the electricity system. And though a number of innovative solutions have emerged to capture value from these trends, we're still living in a world where all of these stakeholders are operating in walled gardens. Managing an increasingly decentralized grid composed of digitally connected devices with a top-down, centralized, segmented approach has its obvious limitations. We think blockchain has the potential to be a foundational digital infrastructure that enables a highly renewable, customer-driven, and intelligent grid. Blockchain potentially allows us to do something that we've never really been able to do before at scale, and that is to create markets that allow devices to autonomously and in a trusted, decentralized way trade energy with each other to help balance the grid. I've been talking about blockchain in somewhat generic terms so far, but as I mentioned previously, not all blockchains are created equal. There are a number of different blockchain platforms out there, both public and private, and it's important to think about how we should choose the right one for the energy sector. Well, energy, and specifically electricity, is unlike most other products. Its centrality to society and its unique physical characteristics make the electricity sector one of the most heavily regulated and technically intricate in the world. From a regulatory perspective, reliability and affordability are absolutely paramount, and underlying all types of regulatory regimes are trillions of dollars of physical assets that generate, transport, and use electricity that need to constantly balance supply and demand across vast geographic areas on the timescale of milliseconds. In this physical world, is orchestrated by an assortment of operating, information, and communication technologies. So if we think about blockchain in this context, we need a platform that is highly reliable, regulatable, and then scalable in order to process the millions of physical and financial transactions that occur daily. From the blockchain developer perspective, there's also some challenges with many of the existing platforms out there today. So EWF did a poll of some of the developers in our ecosystem, and scalability and privacy emerged as the two biggest barriers to wider adoption. And there's good reason for this. So in public blockchains, anybody can read the entire history of the transactions, and nothing is private, though data is largely anonymized through keys rather than people's names, for instance. But even so, this is really a major red flag for both energy companies and for individual customers. Public blockchains to date also have relatively limited throughput, with an average between 3 and 30 transactions per second, depending on the platform. Considering the scale that we would need to achieve a decentralized energy exchange with thousands or even millions of endpoints, that level of throughput really won't suffice. So the Energy Web Foundation was formed to address these technical challenges and also reconcile the fundamental nature of an open source blockchain technology stack with the regulatory requirements in the energy sector. And there's a lot of activity in this space, but we believe we fulfill a distinct need in the market. Unlike many of the other projects that are out there, we are focused really on the core blockchain infrastructure rather than specific applications. However, we have an ecosystem of energy market participants, startups, and investors who are working on building new applications on top of that core infrastructure. And unlike some of the other blockchain projects specifically, we're really focused on the energy sector specifically, and have that partnership that we think is important. So EWF organizes our work into 4 areas. We are first building, as I mentioned, the open source blockchain technology that is tailored for the energy sector, and cultivating an ecosystem of major energy companies, startups, regulators, and investors. We're also engaging directly with regulators, both to help them understand how blockchain can make their jobs easier, and also to help inform policies that might be needed to ensure that electricity remains reliable and affordable in the face of significant market transformation. And then we're supporting our group of roughly 50 affiliates to help bring blockchain applications to the market. And kind of on the who is Energy Web Foundation, it is a standalone nonprofit foundation that was co-founded by Rocky Mountain Institute and Grid Singularity, who is a blockchain company based in Berlin. And then we've also partnered with some leading blockchain developers, Parity Technologies and Slockit, to help us build the core platform. And I won't get into every single line item here, but this provides a rough overview of the energy-specific features that we're developing for the Energy Web blockchain. We started with the Parity client of the Ethereum blockchain stack, and then we've changed a few things like the consensus algorithm and added some new features that don't exist on the Ethereum mainnet to date to really create a separate and parallel chain for energy sector transactions. And I want to just briefly touch on 3 new features that are relevant. So the first is WebAssembly, which is effectively a way to translate high-level programming languages into code run by the blockchain network And WebAssembly expands the programming languages to include things like C++, which will dramatically expand the talent pool and simplify development on the blockchain. The second is private transactions, which we think is a necessary feature to allow parties on this public network to shield details of certain transactions while ensuring that the transactions are compliant. And then lastly, we have a light client, which is a way to connect very simple hardware, everything from potentially a smart meter to a PV generator or anything with an internet connection to connect to the blockchain cheaply and effectively without having to maintain the full network itself. We're also introducing a unique governance model, and blockchain governance is a really meaty topic that probably deserves its own session, and I'm not going to get into the full details here, but this is really an important piece when we think about the energy sector and the various regulatory regimes, as well as potential liability, incentives, and power in a system that's so physically integrated with our day-to-day lives. And this is a new model that's trying to balance the benefits of decentralization with the realities of regulatory oversight. And if folks have questions, be happy to get into this later in the discussion. This is a simple network diagram that illustrates the different types of participants on the Energy Web blockchain. So first, we have a pool of vetted but diverse authorities who are responsible for validating transactions and maintaining the network. Because their number is limited, we can dramatically increase the throughput while maintaining reliability and security, as well as reducing energy consumption of the network itself. But we also want to allow any public participant to interact with the network, whether that's to develop applications or conduct transactions. So here you'll see any public participant can connect, but they just don't necessarily have the authority to actually validate transactions. And then we're introducing a separate vetting process that will enable some regulatory oversight of specific applications and programs. And then we can allow those whitelisted participants and applications to conduct private transactions that won't reveal details to the broader network. And that's something we're really excited about. So I've mentioned scaling a few times, and we continue to see this as a really important piece for blockchain and energy. And so our technology roadmap is really focused on this. And I just want to touch on one mechanism here that I think is worth noting. There's an emerging technology called Polkadot that is going to allow all different types of blockchains to interoperate. And so not only will this increase throughput by splitting the work across different networks, this could allow us to create all types of parallel chains to integrate with the main chain. So these parallel chains could be dedicated for specific geographic areas or for specific industry segments. And as I mentioned, technology for technology's sake really won't have an impact. So we are dedicated to building this ecosystem of affiliates and creating an invested group of developers and users who are excited about the technology and using it for valuable purposes. And as of April, we now have over 50 affiliates who are running pilots, testing ideas, and actually bringing applications to the market. So I want to now go through some of the activity in the broader blockchain and energy space and talk about a few use cases that we're particularly excited about. Blockchain has really taken off in 2017 and through the first portion of this year, and it's made a lot more than headlines. So in the energy sector alone, over $350 million has been raised by roughly 150 companies who are active in this space. And these numbers are all approximate because things move really quickly, and likely these values are already obsolete. And so does that mean we should expect that the blockchain revolution is going to happen any minute now? Well, the simple answer is no. And this technology is still very much in the research and development phase. We've pieced together some data from a number of different sources, and though the exact values are approximate, there's a clear pattern here. There's a lot of investment and announced plans to either build applications or run pilots, but really the majority of projects that have taken place are limited in scope to pilots, and depending on your definition, there's really only a handful of commercial applications out there. So simply put, blockchain is not ready for the mass market yet. And it's also important to be realistic here, because there's a ton of hype out there and quite a bit of what we call block washing. So to be clear, blockchain definitely can add value in a number of settings, but it is not appropriate for every single use case. I find it helpful to think about 3 questions when evaluating whether blockchain is useful or relevant for a particular use case. So first, do you have multiple parties that need to both validate and agree on data? Is it appropriate for a single entity or organization to own that data? And does a decentralized computing architecture provide benefits from an efficiency, cost, or resilience perspective? If the answer to all 3 of these is no, then you probably don't need blockchain. But if the answer to any of them is yes, then there might be something there that's worth pursuing. At EWF, we've evaluated over 100 different use cases, ranging from internal process improvement and cost savings to significant business model transformations. And beyond energy, the use case list goes on, from insurance to real estate to digital identity and finance. But to date, we've narrowed our attention and focus to really make progress in 5 use case domains. And those are certificates of origin, or as they're better known in the US, renewable energy credits, demand response, utility billing, electric vehicles, and transactive energy. And within each one of these domains, we have affiliates who are actively working on new applications and projects. Beyond our direct affiliate group, we have other startups in the blockchain space who are starting to build their applications on top of the energy web chain. And so we're really excited about some of the early progress that's been made to date here. I want to now do a little bit of a deep dive on certificates of origin, which we think is one of the most promising near-term opportunities for blockchain to add value in the energy sector. So certificates of origin today, the market is pretty fragmented. There's different regulatory regimes, and depending on what geography you're in, but almost universally, the process for issuing, trading, and then claiming energy credits is pretty complex. You have generators that need to go through a certification process. There's an annual audit to make sure that they are in fact renewable and they are who they say they are. There are different proprietary tracking systems that will measure the output from generators and create certificates. You have brokers serving as intermediaries to either put these certificates on exchanges or have them sold directly to buyers. And importantly, this is all a costly and complex process, and certificates are typically issued in blocks of megawatt hours. So when you combine this complexity with the size of your average renewable credit, it really limits the opportunity to the largest generators and buyers. And we've seen that today. The renewable energy credit market is really dominated by companies from the Fortune 500, and small to medium businesses, let alone individual building owners and residential customers, are largely limited or shut out of this market. We think that blockchain can radically simplify this process by using light clients to directly connect renewable generators to the blockchain, use programs on the blockchain that measure the output of that generator, automatically create these certificates, and create markets that allow buyers to directly purchase these credits from the generators. And with that level of trust and auditability that's inherent in blockchain, and we think this can drastically lower transaction costs, reduce the amount of time it takes to settle down to minutes instead of weeks or years, and improve both cybersecurity and transparency in this complex space. So EWF has actually built our first application running on the blockchain that we call Energy Web Origin. So Origin is capable of automatically tracking the ownership of renewable energy at the kilowatt hour level. In addition, we've introduced some new functionality that adds other attributes to those certificates, and those include location, the time it was produced, the exact type of renewable energy, and importantly, the CO2 impact of that kilowatt hour. We've partnered with an organization, Watt Time, based out of Oakland, that has technology that can measure the carbon intensity of grids in real time. And so by simplifying the process, making certificates more granular in kilowatt hour increments, and having this expanded functionality, we think there's a lot of value for new market participants, particularly some of the smaller organizations or individuals that have been shut out of this market. And there's a way to more effectively and in a more sophisticated way think about purchasing renewable energy, because you might value other attributes besides just the fact that it's renewable, like I've talked about before. And so we've already done demonstrations with both some large organizations. On the top there, you'll see NG and Microsoft. Those are still major utilities and large buyers. But down towards the bottom, we're also able to now do it at a very small scale, from households to smaller organizations. And with some of the other attributes that we can now assign to given kilowatt hours, there's different ways for buyers to value those certificates. And so here's a screenshot. Within Origin, the user interface, you can see production assets, and across the bottom there, you'll see all of the different attributes that are associated with any given asset. You can also see consumption assets with a similar level of granularity into the different attributes. And then you can go a level further and see all of the details or relevant attributes that you might want for either one of those assets. We now have also a functionality that enables you to see energy certificates that are for sale across the globe. So we think this can dramatically expand markets. And even if you live in one location and you want to buy a credit from somewhere else, that power obviously may not physically be delivered to you, But by expanding this marketplace over the medium and longer term, we hope that this can incentivize the right kind of development and purchasing behaviors across geographies and create stronger incentives for renewable adoption. But ultimately, this is about simplifying the process. So using the blockchain to automate all of these back-end measurement and verification and settlement processes to give you a clean user experience that allows you to buy renewable energy with a single click. And so getting a little bit further down the road, thinking about the capabilities of the technology, I want to now paint a picture of where we might be heading over the years to come. And to give a specific example of what you as a building owner or a residential customer, how you might think about your energy data and your energy consumption in the years ahead. So in the 20th century, thinking about this question, who owns your energy consumption profile, is irrelevant because we had meters that were typically read manually only once a year. In the last decade or so, we've seen smart meters that can measure consumption much more granularly being rolled out, and we have more sophisticated data, but you don't own that as the consumer. Somebody else, whether that's your utility or potentially a third party, is monetizing it or in cases inadvertently making that public. We think with a blockchain-based system, we could flip this paradigm so now you own your data. And with the right level of granularity, that data or your consumption profile could be pretty valuable and you could do some interesting things with it. So imagine that your home is full of different internet connected devices, and maybe you have rooftop solar and a battery system and some potentially flexible loads within your house. So you could store all of this data on a public blockchain, but encrypt that data so that only you had the keys to it. And then you might be able to offer that data to different retailers depending on your regulatory environment and whether or not you have competitive markets available to you. And so then we can add analytics and different applications to come up with interesting insights based on that data. And you might be able to then negotiate between these different retailers to get an optimal price. You can turn your bill into an automated application on the blockchain, do all of your payment and management on a single app. And if you had the right data and the right type of products and services available, you might have a third party that can now offer you ways to really effectively optimize your energy consumption, whether for your own personal cost parameters or for the conditions in your specific grid or for other things you value, like carbon intensity or any other attribute. And think about, where could this ultimately go? So we're seeing this clear transition where we're moving from a world where all of the value and the focus in the electricity system was on the large scale, on centralized generation facilities, massive transmission and distribution infrastructure. And the ratepayer is kind of an afterthought who, kind of is a passive participant in all this and funding, all of the construction and operations of these big assets. In the future, with a decentralized system, with more sophisticated digitalization of these different assets and greater adoption of distributed energy resources, we could flip this on its head, where the value is really at the grid edge, at the customer, and focusing on services rather than deploying capital into huge infrastructure. And we think long-term, the future really could look different, where we have decentralized, recursive, transactive energy markets that start at the bottom and aggregate at each level of the grid into larger and larger grids that are composed of nested copies of themselves. And we recently released a paper that highlights this vision in more detail and what blockchain's role could be. And that's where that image on the right comes from. It's available on the Energy Web website. So with that, I know we have about 20 minutes or so left, and there's a lot of content to get through. So I'm sure there might be some questions on specific things, and happy to open it up for discussion now.
Great, Sam. Well, thank you very much. And like Sam was alluding to, please send in your questions that you might have via the questions box on the side of your screen. I know I've got a couple, Sam. And one of the big criticisms that we're seeing with blockchain is its own energy usage. Mm-hmm. The computing power that's needed. Can you talk a little bit about that concern and also what might be being done to address that?
Yeah, so folks have probably seen articles and reports. There's been, I think, a report just came out maybe last week on Bitcoin's energy use, and it's now estimated somewhere between 0.5% or maybe 1% of global energy use, which is astonishing and completely unsustainable on multiple levels. The big reason for that is that Bitcoin and some other public blockchains use a particular method for securing the network that is called proof of work. And in proof of work, you have transactions that are happening on the network, and the transactions get organized into blocks. You can think of that as filling up a page with data. And when you get to the end of the page, you want to add it to the ledger, right? You want to add that block to the chain of blocks. In order to do that, all of the computers in the network engage in a race to solve an extremely difficult mathematical puzzle that can only be solved through trial and error. And when a computer figures out the answer, it broadcasts it to the rest of the network, who can then validate that that answer is correct. The network achieves consensus. That block is added to the chain. So while this is a highly secure way of managing this decentralized network, that process of solving that mathematical puzzle is extremely energy intensive. It's partially by design, right? It adds a deterrent for anybody to try to game the network, because you have to devote a lot of money and computing resources to it. So that's one methodology for securing a blockchain, but it has this energy intensity problem. The Energy Web chain uses a completely different consensus mechanism. So rather than having a fully open chain where anybody can join the network and become a miner, that process I just described is called mining. We have a set of criteria that a organization or an entity must meet in order to become an authority, and we are effectively limiting the pool of computers that can authorize or validate transactions to a group of known entities. And so since we've now done this vetting process, having this energy intensive race to solve such a difficult computational problem isn't necessary, because the big contrast is, in Bitcoin and other networks, anybody in the world can join. In this network, there is a vetting process that you have to go through to identify yourself, and because of that, the computational burden to validate each block is significantly less. This is called a proof of authority network, and we're still in our test network phase, but our initial data suggests that our network is currently having a peak demand somewhere between 1 and 3 kilowatts. So just a little bit bigger than a couple of microwaves maybe. at scale, where we hope to grow the network over the next year or so, the whole network might use as much as a medium-sized office building rather than a medium-sized country, which is what we see with proof of work networks today.
Very good. Gotcha. Okay. David had a question. He wanted to know, you mentioned selling your information to specific retailers. I think it was towards the end of your presentation. Mm-hmm. Do you foresee the ability to prevent them from then reselling that data?
Yeah, so the way you can build applications or smart contracts on a blockchain, you could say open up access to that data for a defined period of time, and you can write in the code that it's limited to one other address, and that data cannot, I guess, if you open up data, somebody could transcribe it or otherwise do something off of the blockchain to acquire it and then maybe sell it. But within the blockchain, you can design these applications to have a very deterministic way of preventing things like that from happening by either having things close over temporal windows or explicitly defining the other participants who can see it. And hopefully that helps clarify.
Gotcha. Okay. Well, a follow-up to the...
I would add there, sorry to cut you off, but is the big difference here is that data is not stored on when you share it. You're not transferring it to some other proprietary network. You are maybe opening up visibility to that data that is stored on this decentralized network for a period of time. So that's the other major difference here. Nobody has it on their servers. It's a fundamentally different architecture there.
Gotcha. Staying with the data topic for a minute, Kim wanted to know, let's say that there's someone who lives in an area with a monopoly energy utility, and it doesn't matter, it could be a rural co-op or it could be a publicly traded company. He's wanting to know, what value does his usage data have in a retail market, if any?
Yeah, so there's in a vertically integrated, regulated monopoly territory, a lot of these ideas, don't quite apply. That said, there are other potential ways to capture value here. So one is, we have as part of our affiliate group some of these utilities that operate regulated territories, and there is talk of well, what if you changed regulation such that rather than having utilities, get a guaranteed return from investment in capital, they get guaranteed return from performance or from offering platforms. And so through that, you can envision maybe a regulated utility having a platform where they could enable individual consumers and then third-party service providers in the utility to kind of share access to certain information. Third-party service providers can maybe be offering you as the customer things like storage or rooftop PV or demand management services, offering those services to the utility, and the blockchain in that scenario could be that common platform for doing settlement and measurement and verification and kind of streamlining some of that processes. But that's why that's a pretty narrow scope, and even as what I've described, you don't necessarily need a blockchain for that. So in vertically integrated territories, we do think that if one of the biggest levers that we could potentially kind of pull is helping reform or transition utility business models and regulations to be a little more customer centric and allow a little more degree of customer freedom.
Gotcha. Okay. Charlie's got a question in regards to validating authorities. He wanted to know if limiting the number of validating authorities could possibly lead to corruption.
Yeah, so this is it's blockchain governance is actually my favorite topic in this space, because it's really fascinating, right? You start to raise all these questions. If we are by definition limiting the number and having some kind of gateway that an organization or an entity needs to go through to become an authority, right? Now we're introducing some level of centralization. And that's true. There are a number of different ways that we've tried to address these issues in the governance model. So firstly, our goal is to have a diverse and large enough pool of validators that just from a practical standpoint, that kind of collusion or attempts to kind of game the system would just be really difficult to coordinate. We want to ultimately have in the thousands of validator nodes. Secondly, we have this, if on the bottom left here, this initial validator requirements. So Energy Web Foundation will, when the full network goes live next year, there will be a set of criteria that an organization must meet in order to become a validator node. So there should, at least in theory, already be some way of establishing trust for a given party. But things change over time, et cetera. So there are then on-chain and off-chain governance mechanisms to kind of guarantee the integrity of the network. On-chain, you could be kicked off of the network for things like failing to validate a block when it is your turn, for intentionally trying to manipulate data and broadcast that to the network, et cetera. That's stuff that you can program. There's also things that happen off-chain that are relevant but would never be able to be programmed. Kind of the example we use is, what if you had some energy company that decided to just start selling uranium to some rogue terrorist organization, right? That's an objectively bad behavior that we would want to remove that authority from, but you don't program it. So that's why there will still be, there's still a human element to this. There's human oversight of this system. And then the third piece is in this proof of authority mechanism, every authority has to stake a number of Energy Web tokens, which will be the native digital asset on this platform. And that is a way to further disincentivize bad behavior, because if you break the rules, you effectively lose those tokens, and getting into that kind of goes down the realm of crypto economics and some of the incentives there. But at a high level, that's the approach that we're taking.
Gotcha. All right. Want to make sure that people get in their questions while they still can. I know I've got a couple more for you, Sam, but just kind of making the last call to our attendees. One of the questions I had for you was, some of our attendees have probably seen commercials for companies, whether it's a bank or Venmo or something like that, where someone can pay another individual via their mobile phone. Mm-hmm. Is that activity currently using blockchain? Or if it's not, I'm assuming it could, right?
Yeah, it could. I mean, typically, if if you're doing a bank-to-bank transaction, or even PayPal, right, you are giving that organization kind of the implicit authority and responsibility for holding or managing or transferring your funds. Typically, those organizations are not using blockchain. Some financial institutions have started using different distributed ledger that are similar to blockchain, but typically, kind of private consortium networks, to kind of streamline that process between bank to bank or between bank to PayPal to bank. From a technical perspective, there's no reason why those types of transactions couldn't happen on a blockchain. And in fact, that's Bitcoin's reason for being. It enables me to pay you, but instead of having any third party involved, it's just a direct transfer of a Bitcoin asset on this decentralized network.
Right.
The challenge just kind of becomes reconciling maybe some of the incentives for those third parties. Why would they necessarily want to give up that authority or relationship with you, for example? But it's certainly
the monetization of that.
Exactly.
Yeah. Okay. Well, the last question I've got for you then is, what kind of cost savings, and not exact, but is there any kind of ballpark range as to what kind of cost savings the blockchain represents for, I'll call it the affected sectors. I don't want to restrict this question just to the banking sector, even though they seem to be the common thread, but there are obviously other sectors that could be affected by blockchain. So, how big is the savings represented here?
Yeah, that's a really tough one to answer in anything beyond general terms. Right. Firstly, because one, these are largely hypotheses that we have, and initial pilots have some interesting data points. But as I mentioned, we are not at the level of mass market adoption, and we can't definitively say, oh, well, in the old world, this is how it was, and in the new blockchain world, this is how it is. With that said, we believe each one of these five, the reason that we have focused on these five use case domains is because we believe that the global market opportunity is greater than $1 billion a year, either from cost savings or from new market entrance and participation. And at least in the top four, certificates of origin, demand response, billing, and EVs, there are some pretty obvious near term, and by near term I mean 1 to 3 year opportunities to capture value here. The transactive energy piece, a lot of other people call it peer-to-peer or local energy markets, or there's a lot of different names for it. That's kind of the long-term vision, and where we think ultimately, all these other things roll up into transactive energy. To get there, there are huge regulatory barriers that would need to be addressed. There are technical questions about just the physics of grid management that remain to be answered. But we are excited about that, and this is what motivates me and others on the team, working to answer some of those questions and figure out answers to actually achieve that. But unfortunately, I can't really give a more specific answer than that, because I honestly don't know.
No, it's okay. I figured it would, was kind of a range or an estimate or a theory. And as time goes on, I think those numbers will maybe come into clearer vision. So it's okay. Don't worry about it, Sam. Well, I don't see any other questions, Sam. So I really want to appreciate you joining us again today for this second installment of this topic. I think it's one that is certainly coming down the road at us, whether some of us realize it or not. It's coming. So I appreciate you kind of giving us this look into the future.
Thanks for having me.
I also need to say thank you to our audience for sending in questions and for attending, and obviously thank you, as always, to NV Energy for their sponsorship of these webinars. We're going to be back again in a little over 2 weeks. We're going to get an update on the 2018 IECC. It's out there now, obviously, and it's being adopted by some states, or being considered to be adopted by some states. So we're going to have Jim Myers from SWEEP join us. And so come back on Thursday, June 7, and that's going to be at 2 p.m. Eastern Time. We'll talk a lot about energy codes. Until then, Have a wonderful Memorial Day weekend. Stay safe out there. Goodbye.